Good morning, and thank you, Ian, for that introduction. So I'm here to talk about portfolio diversification and, more importantly, how to diversify your investments in the income component of your allocations. So we'll just skip past the disclaimer, and now portfolio diversification. So why the need for portfolio diversification? When you sit down and think about it, diversification is generally well understood in the market by a lot of investors. But it needs to be in simple terms, which Ian's also just stolen my thunder, is don't put all your eggs into one basket. So why now? Why are we harping on about diversification? In our belief at Gryphon Capital, we see it's more important than ever to be diversified. So why do we say that? What's driving this sort of apprehensiveness within the markets from investors? It's because our view is that when we look at the traditional asset classes, the returns, the likely returns, I should say, that we see going forward feel to us that they're going to be lower than all their historical averages. And as investors, we don't like lower. We like higher, increasing returns. But saying that as well, so we're projecting and getting our portfolios positioned to extract the best risk-adjusted returns. But also, this other conundrum which is engulfing the market is what the market refers to as risk-on. All the assets that we use to grow our wealth and prosperity is used typically in equities, property, and obviously also bonds. And bonds haven't in Australia been used as a tool, but with interest rates declining, bonds price appreciate. So, with that in mind, why don't we take a look at the pie charts that I have above. Have a look at the asset allocation between the average superannuation institutional investor, which is on the left, and then the average self-managed investor on the right. What's glaring from these two pie charts is really the split between the two the market refers to the more conservative levers within your asset allocation, be it cash and fixed income. The institutional superannuation investor has decided on an allocation of roughly half and half. Half cash, half fixed income. Where the self-managed investor has decided to keep a cash component of 28%, but only a 2% weighting to fixed income. So the question begs to why is the self-managed investor only 2% invested in fixed income? So when we've discussed it and talked to a lot of industry people, we believe that the reason is that the self-managed investor hasn't had the viable options to invest in the fixed income market. So what I'm here to talk about is one, the case for fixed income for the self-managed investor, but more importantly or specifically, an investment in the Gryphon Capital Income Trust, which invests in a sector of the fixed income market. So, why hold fixed income? Take a step back. Let's go to definitions. What is fixed income? Okay, fixed income, it has a defined life, where an equity is what we refer to in the markets as a perpetual security. It has no defined life. In fixed income, you borrow the money one day, you pay it back at the end of that time period. So, its design, the fixed income, its design, and the evaluation of the fixed income instrument should be premised, what on? The return of getting your money back. Okay? So in its basic, most basic form, what is it really? It's where a borrower is committed to pay an agreed rate of interest on the amount borrowed over a set period of time. Okay? So over those times, he makes predictable payments. Where you as the bondholder, you get those payments. And then at the end of that life of that fixed income investment, you get repaid your capital or the amount borrowed back. In the financial markets, we refer to this as bond investing. Okay? So it's bonds that we at Gryphon Capital invest in. The bonds that we invest in, more specifically, are called secured bonds. The secured bonds that we're investing in deliver a predictable monthly income stream. Okay? So when we're talking about the fixed income investment, every month that borrower is paying interest on a monthly basis. Very predictable, frequency monthly. Whilst, what do we need to be concerned about? The return of our capital. In our opinion, our expert opinion in this asset class that we invest in, provides a high degree of comfort surrounding the safety of your investment. So, we've talked about bonds, we've talked about the returns, now we've talked about the principal. Now we need to consider, okay, what is the amount? What is the sort of, how do you value the income component if it's much higher than other competing cash and deposit-like products? So in terms of our investments, the income that comes off these bonds is much higher than cash and other deposit-like products. So we see that because we've given that investment, which is materially above the cash and deposit rate, therefore we are providing an alternative solution to savers in this country, which really have faced a dilemma since the global financial crisis, where we saw rates around the world collapse. We didn't normalise for a long period of time. Our normalisation in terms of the interest rates was delayed because of the mining that was obviously kicked off after the financial crisis here in Australia. So since then, we've now normalised, and now we're finding it difficult to extract the income off our traditional income sources, be it cash and deposit-like products. Now, when you invest in bonds and you're seeking those higher income levels, it can't come at the expense of your volatility, or what we refer to as price movements of the investments that you've made. And why do we say that? Why do we say that it can't come at the expense? Because if the bond price that we invest in is moving around and is quite volatile, that breeds uncertainty about the return of your capital. So when you're thinking about it as an investor, what are you trying to do? You're trying to optimise the highest level of income for the least movement in the bond price that you're investing in. Okay? And then lastly, what we're trying to do here is we're trying to widen the toolkit for those investors who are seeking to diversify into other asset classes, whilst at the same time we want to preserve their capital. That is the fundamental driver. We're trying to expand the toolkit. And then lastly, within the diversification story, there's a second order effect that it's known as correlation. And that also should come into when you're calculating your diversification with your asset allocation, that your products aren't as correlated to each other, okay? But that's for another day. So, what are the listed income alternatives available on the market? As Ian's pointed out, in the last 12 months, we've actually seen the emergence of a new ASX-listed sector, where that sector, the focus is on generating income from fixed income assets. To date, there has been 3 of these listed income trusts that have been listed on the Australian Stock Exchange. Each of these listed trusts come from a different subsector of the fixed income market. It's now totaling $1.3 billion. As you would have seen from Ian's slide, we've raised $175 million. There's 2 other products that have also listed. Ours and another product are domestic assets, and the one that's just listed that Ian referred to is international in terms of its jurisdiction of the fixed income assets. So totaling $1.3 billion, 175 from us, and the balance in the other 2 competing strategies. So we've got different subsectors of where we're driving our fixed income, so very, very different. But what is the main objective of these 3 strategies? And it's all consistent within the 3 strategies, is that the objective is to provide high but stable returns consistent with the long-term preservation of capital. Finally now, that gives us the ability to now access and to provide access to the self-managed investors who too are also looking to get access to a product which traditionally has been in the main stomping ground of the big institutional investors, is now available to the self-managed investor. And now this listed form of fixed income has now provided a visible and transparent, and that's important because investors want transparency, okay, of this new asset class, and it's enabling the new breed of investors to engage, okay, and that is important for us to be able to grow the market. It's also competing with the other traditional sources of income, being cash and deposit products, as well as the bank hybrid market. So let's fast forward to our offering, the Gryphon Capital Income Trust. Financial markets love using acronyms and jargon, so GCIT, the GCIT offering, it stands for the Gryphon Capital Income Trust. The target return is 5% net. This return is a floating rate return, and what we mean by floating rate, it's comprised of the cash rate plus 3.5%. So if the cash rate goes up from 1.5% to 2%, add the 3.5%, the total net return will be 5.5%. Likewise, if the cash rate falls from 1.5% to 1%, the total net return will be 1% plus 3.5% equals 4.5%. The income, as we've discussed just briefly, is paid monthly. Now, what's really important, as we've discussed, is obviously that return of our capital. So within that, capital preservation has to be embedded into our DNA, okay, at Gryphon Capital. Because when you invest in bonds and fixed income, it's all about the return of your capital. It's embedded. We've got a very long track record of producing what we refer to as low volatility returns, i.e. the returns that we produce comes with very little volatility on those bond prices. Therefore, if you go back to what we're talking about within fixed income, what is the optimal solution we're seeking? It's the highest amount of income for the least movement in the bond price. That's critical when it comes to investing in bonds. And because we've been able to generate that, that's enabled us with our partners when we've come to the listed markets, the ASX markets, is to offer that to investors, self-managed and retail investors. Because before, it's only really been part of the audience of the big institutional investor market. So we're giving you access to that market that's typically just been part of the institutional landscape. So at Gryphon Capital, what are we referred to as? Are we a generalist fixed income manager? Are we boutique? We're regarded as a specialist income investor. What does it mean? What does specialist mean? Well, specialist means we dedicate all our resources, our experience, our systems, everything is targeted to just one subsector of the fixed income market. We don't take interest rate risk, okay? We only invest in one sector of the market. So what's the sector that we've chosen to invest in and pour all our resources, time, effort, expertise into? We've chosen the RMBS, the mortgage sector, the RMBS and ABS sector. So who's partnered with us? Who's been our clients on this journey? Well, namely, typically it's insurance companies we've partnered with, and also an industry fund has also partnered with us in this area of expertise. And lastly, we offer a low competitive fee structure with no performance fees on any of our mandates. So this is a more succinct, not as wordy as Ian's, but what we just are attempting to do here is just to outline the three options for if you choose to invest in the fixed income market. As you can see on the left, there's the listed investment company, which is LIC, referred to as LIC. Then there's the listed investment trust, which is referred to as LIT. And then there's the ETF, which stands for the Exchange Traded Fund. For the purposes of this discussion and due to timing, I'll just focus really on just the LIC and the LIT. The table is outlining the similarities with also some differences. But the question that's mostly asked is, what's the difference? What's the difference between an LIC and an LIT? And the major difference, and Ian rightly pointed out, there are other differences, but the major difference comes down to the income. When you invest in assets in an LIT, the income generated off those assets is passed through to the unit holder in terms of what we refer to as a distribution, but it's untaxed, okay? It's taxable in your hands. Whereas in an LIC, the income generated on the assets is taxed within the company, and then if they choose to pay dividends, would come in the form of franked dividends. Okay. A little plug for GCIT, the Gryphon Capital Income Trust. As you can see from the chart in front of you, or the table again, what we're looking here is to give investors a sort of snapshot of what we said when we were out raising the IPO back in May of this year. And what was the success of it? So we actually came out and we marketed and we gave IPO targets and ended up raising 175 million. And what I want you to take away from this little table is when you go on you marketing in terms of a public disclosure document, you actually got to come up with some investment guidelines. And coming out with investment guidelines, because we don't believe we can time markets and predict the absolute future of where everything's going, but we have a very, very specific knowledge set about this asset class. So you spend an enormous amount of time debating about what is going to be the right investment guidelines that we see are appropriate for the target return that we're looking to extract. And with that, you've got to be able to come up with guidelines and ranges that tells the investor that we're not really straying too far from our core competencies, but you've got to have enough flexibility in the investment guidelines to achieve the target returns across a number of scenarios. And what this enables us to say in our markets, that when we talk to investors and clients, and what's imperative is to be able to say, we've erred on the more conservative side of the actual IPO target ranges. That means we are now, and we can say what we said in the IPO back in May to what we've produced in terms of as we stand here today has been true to label, okay? And you'll hear this term true to label with some of the independent research when Peter gets up and speaks about it. But true to label is very, very important to the investment research houses, because they look at those, what you said to what you produced, and it's very important to them because they are reviewing the robustness and the quality of that product offering for you. And for that, they will come up with a rating grade to how they've assigned the quality of that offering. On the client side, on the investor side, when you are achieving true to label, okay, it's very important because true to label then promotes trust. And that's what we're looking to engage with investors on, trust. Thank you for your time. If you would like a copy of the presentation, hard copies outside at the table. Otherwise, you can just visit our website on www.gcapinvest.com. Again, thank you for your time.